Using annuities to build a private equity strategy, a new approach to long-term wealth. Annuities are a traditional tool for retirement income planning, offering steady returns and a reliable income stream. However, they can also play a unique role in building a private equity strategy, a field typically focused on high-growth, high-reward investments. Leveraging annuities in a private equity portfolio is an innovative way to achieve stability within an otherwise volatile asset class, helping to offset risk, generate liquidity, and maximize returns over time. Here's a closer look at how annuities can be effectively integrated into a private equity strategy. Understanding the role of annuities in private equity. Private equity investments are often characterized by their long-term horizons and illiquidity. While these investments can yield high returns, they also come with significant risks and periods of low liquidity. By incorporating annuities, investors can balance their portfolios with a steady income stream, which can be particularly beneficial during times when private equity investments are underperforming or waiting to mature. Annuities provide predictable income streams. Regardless of market conditions, annuities guarantee a specific return. Risk mitigation. Annuities' low-risk nature helps counterbalance the high-risk profile of private equity assets. Liquidity support. Annuities generate cash flow that can be reinvested or used to manage private equity fund expenses, including fees and management costs. Choosing the right type of annuity for a private equity strategy. There are different types of annuities, each with unique features that can complement a private equity strategy. Here are a few that may be particularly suitable. Fixed annuities. These annuities provide a guaranteed interest rate, making them an excellent choice for those looking to balance high-risk private equity investments with steady returns. Fixed annuities act as a conservative hedge, offsetting the high risk inherent in private equity. Variable annuities. Variable annuities allow investors to invest in a range of mutual funds within the annuity, giving some exposure to growth potential. By choosing funds that are aligned with the risk profile of their private equity holdings, investors can achieve growth while still benefiting from the annuity's structured income stream. Deferred annuities. These annuities allow for tax-deferred growth, which can work well within a private equity strategy. Investors can allocate funds to a deferred annuity to accumulate wealth and later transfer a portion of it to private equity opportunities, taking advantage of compound growth over time. Integrating annuities with private equity to improve cash flow management. One of the biggest challenges in private equity is managing cash flow. Investments in private companies often take years to mature, and investors need cash flow solutions to meet obligations during the holding period. Annuities can play an integral role in cash flow management by providing reliable income during periods of illiquidity. This income can help cover capital calls or ongoing investment expenses, reducing the pressure to liquidate other assets prematurely. Example approach. Suppose an investor has a portfolio with significant private equity commitments and anticipates capital calls in the future. By placing a portion of their capital in a deferred annuity, they can schedule income payouts that align with these capital calls, effectively managing liquidity. Using annuities to optimize the private equity investment lifecycle is a strategic move. Private equity funds typically follow a life cycle that includes capital calls, investment, growth, and eventual exit or liquidity event. Annuities can be structured to complement each phase effectively. Funding capital calls. As annuity payments come in, they can be used to meet capital calls without selling other assets, preserving the portfolio's overall balance. Supporting growth investments. During the growth phase, when funds are tied up in private equity investments, annuity payments provide supplemental income, offsetting the lack of immediate returns from the private equity assets. Enhancing the exit strategy. Upon exiting a private equity investment, an investor might face uncertainty regarding reinvestment. Fixed annuities can serve as a parking strategy, providing income while new opportunities are considered. The tax advantages of annuities in private equity strategies are significant. One of the key benefits of annuities is tax deferral. In a private equity strategy, Tax-deferred growth allows an investor to compound gains more effectively over the long term, resulting in greater potential wealth accumulation. Tax deferral can be especially valuable when reinvesting returns from private equity holdings back into the annuity, allowing for compounding without immediate tax implications. Here's how the tax advantages of annuities might work with private equity. Deferral of gains. Private equity investors can use annuities to grow their wealth without triggering tax events, allowing them to accumulate more substantial wealth over time. Income tax timing. Annuity payments can be structured to delay taxable income until the investor is in a lower tax bracket, which may coincide with retirement, maximizing after-tax returns. Creating a balanced and diversified portfolio by combining annuities and private equity can be highly effective. Investors can capture the growth potential of high-risk investments while maintaining the stability and predictability of fixed income products. A balanced approach is essential for long-term wealth creation, especially in uncertain markets. For instance, an investor might allocate 70% of their portfolio to private equity and high-growth assets, while the remaining 30% is dedicated to annuities and other fixed income products. This structure provides both growth and safety, helping to protect the investor's capital while pursuing higher returns. Using annuities to build a private equity strategy may seem unconventional, but it offers significant advantages. By combining the predictability and stability of annuities with the high growth potential of private equity, investors can create a strategy that balances risk and reward, enhances liquidity, and optimizes tax benefits. This hybrid approach is ideal for long-term investors who value both security and growth, enabling them to navigate market uncertainties while capitalizing on unique investment opportunities. Investors interested in this approach should work closely with financial advisors who specialize in both annuities and private equity, ensuring they select the most appropriate products and strategies to achieve their financial goals. As the investment landscape continues to evolve, innovative approaches like these offer a competitive edge for building a robust and resilient wealth portfolio. Here's how using annuities in a private equity strategy to purchase a business like a laundromat could work. Let's say you're interested in buying a laundromat, a business with steady cash flow, but which may require initial investment for purchase, renovations, and some working capital. You want to manage this investment's cash flow while also having funds available for unexpected expenses. Step 1. Initial capital and annuity purchase. You start by allocating a portion of your capital to purchase the laundromat, setting aside another portion of capital to purchase a fixed annuity that will provide you with a guaranteed income stream over a set period, such as 10 years. Step 2. Structuring the annuity payments. You choose an annuity that provides monthly payments, which helps you meet predictable expenses related to running the laundromat. For example, if the annuity pays you $1,500 monthly, this income could cover utility bills, supplies, or occasional maintenance. Step 3. Using the annuity to manage cash flow in the business. The laundromat may not immediately generate consistent income, especially if there's a renovation phase or slower initial growth. Here's how the annuity supports your strategy. Offset operating costs. The $1,500 from the annuity helps cover operating costs, reducing the immediate pressure on the laundromat's cash flow. This lets you avoid using high-interest credit or dipping into other investments. Cover unexpected expenses. Should the laundromat face unforeseen expenses like repairs or upgrades, you have a steady income stream to address these without drawing from business revenue directly. Step 4. Reinvesting profits. Once the laundromat becomes profitable, you could reinvest profits back into the business to drive growth, like adding new equipment, renovating for a modern appeal, or offering additional services. Use the annuity income to fund new private equity opportunities. Step 5. Future options with annuity and laundromat profits. At the end of the annuity's term, you'll have gained steady income that kept the laundromat financially stable, built up a more valuable, cash-flowing business. If the laundromat's cash flow is now sufficient, you could let the annuity lapse, freeing up funds for other investments. Alternatively, you might choose to renew or roll over the annuity, depending on your financial goals. Benefits of using this strategy for a laundromat. Cash flow stability. The annuity provides a reliable income stream, stabilizing cash flow during the business's early phase. Risk management. You reduce financial stress, especially in the initial stages when business income might fluctuate. Growth potential. With expenses covered by the annuity, you can focus on scaling the business. Simple example calculation. Imagine the following setup. Laundromat purchase price, $100,000, business acquisition cost. Annuity cost, $50,000 for a fixed annuity paying $1,500 monthly over 10 years. Monthly laundromat revenue, after expenses, $2,000. By combining the $1,500 annuity income with $2,000 laundromat revenue, you generate a steady $3,500 per month. You can use this combined income to cover any remaining operational costs, pay down any debt if leveraged for the acquisition, or reinvest back into the business. Using an annuity to support a private equity investment like a laundromat can be an effective strategy, giving you a balance of stable income and growth potential. It's a straightforward approach that mitigates risks, maintains liquidity, and maximizes returns over time.